That's whether the business can pay its debts as and when it falls due. So here we use the income statement to show profitability. We use the statement of financial position to show liquidity or solvency. Then we have the cash flow position. This is IAS 7, statement of cash flows. Okay. Now, this is not in your syllabus. Statement of cash flows is not in your syllabus. Our focus is on the statement of financial position, which is also known as the balance sheet and the income statements. Okay. So we are starting with the first one, profitability. And I'm saying that the account that is used to show profit, the statement that is used to show whether the business is making profits or losses is called the income statement. Now, this income statement, there are accounting concepts that underpins its preparation. Such concepts are the margin or accrual concepts. You see, I didn't teach you the margin and accrual. I didn't teach you accounting concepts. The day that I was teaching, I stopped. So margin and accrual, think the prudence concepts. The going concern. What again? And the dual concepts. The dual concept talks about double entry. So since double entry runs through, I think you would have to apply double entry everywhere in accounting. So that's why I wrote the dual concept. Now, the going concern concept talks about the business continuing to exist for a foreseeable future. Thus, the business will not collapse. It will continue to be in existence for a predetermined future. Okay? Yes, so therefore, our opening balances becomes our closing balances for the previous periods, and our closing balance becomes our opening balances for the next period. It means that when we are closing the year, we don't dispose of our possessions, our assets and everything, because we believe that next year will still be in existence. So we carry them forward to the previous year. Now, the prudence concept talks about preparation of profits or estimation of profits. Now, the prudence concept is saying that it is wise. Prudence means wise. When we say someone is prudent, it means the person is wise. Now, the prudence concept says that in the estimation of profits, we should not anticipate for profits. Rather, we should anticipate for losses or future expenses. Future possible expenses. This is what future possible debts. Let me say debts instead of expenses. Future possible debts. Now, this is what the prudence concept is saying. Prudence concept is saying that now, let's say if you make a profit of 20,000 Ghana cedis, and you tell your boss, "Oh, boss, I made a profit of 20,000 cedis." Then, when the auditors came, they recognized a profit of 12,000 Ghana cedis. Okay. Assuming your bonus is tied to your profit you make, your boss would be like, because you are thinking about yourself, you were able to recognize or anticipate for profits that are not realized. Okay, so unrealized profits are profits that you've not earned them. You've not fully realized it. You are just anticipating of its existence. To say car, you've not earned it, but you're anticipating for its existence. Or you believe that, oh, you married them, but actually you've not earned it. Now, the prudence concept is saying that profit should be recognized when it has been actually earned. Don't make provision for profits. Don't think that, oh, in the future, or maybe this gig that I'm going to do the profit be better. No, that's what the prudence concept is saying. But rather anticipate for losses. So, if should the case be that you give your money to somebody, let's say you give your money 20,000 to one of your debtors, or you sell goods worth 20,000 to your debtors, you should anticipate that he might default payment. Okay, you should make anticipation that he will not be able to provide for all the you should provide for he not being able to pay for all the 20,000. So you will make anticipation that Tikana Mdiamana acquire credit worthiness. He might not be able to pay all bad debts. So you've made provision, let's say 2,000. So it means that provision means that you've recognized it as a loss. So if he comes and he pays all the 20,000, then it means that the 2,000 that you recognize as a loss becomes recovered. Thus, it has been realized that if he comes and he can't pay the 20,000 and he pays 18,000, it means that you anticipated for that default payment. Already you've recognized it out, so you don't care. Please, you understand?
Yes, please.
Yeah. So, the prudence concept is trying to make you wise in terms of accounting. Now, this is money, okay? This is money that you are dealing with. If you are not careful, your boss might think you are stealing from him or her. So the prudence concept is a wise way of accounting that comes to guide accountants in decision making that do not anticipate what? That accountants, I didn't say I'm a preparer. The accountant shouldn't anticipate losses.
You can do the arrow to reverse it. Undo at the top.
It will do. That accountants shouldn't anticipate for losses, but rather, shouldn't anticipate for profit, but rather anticipate for losses and future expenses or future debts. Please, you understand?
Yes.
Now, the matching concepts, this one, it says that in the estimation of profits, okay, now this is the main concept in which income statement is built on. It says that we should match all our expenses against our revenues. Now, you see that this concept is saying that to get profits, you should take your revenues less your cost of sales. So this is your revenue, you less cost of sales, then what you get is profits. That's the concept. Please, you understand? So he's saying that we should match all our expenses against the revenues we've earned to get your profits. That's the matching concept. Now, the accrual concept is saying that yes, even though when you are matching when you are matching your costs or your expenses against your revenues, this is what you do. You match revenues that are earned. So recognize revenues when they are earned and not when cash has been paid for it. Now, and it goes further to say that recognize expenses when they are incurred. And not when cash has been paid for it. So this is the accrual concept. Now, what it means is that, let's say you earn revenues, okay? $1,000. This is revenue earned. This is what you've worked. No, this is what you've earned. Okay, this is what you've earned. That's what you've worked for. And the cash you received. Let me say cash received. Okay, if I say cash paid, you think you are rather paying. So the cash you received let's say was 1,200. Please, what does it mean? Hello?
Hi, I'm here.
I said, what does it mean?
Revenue and the cash received. Oh, it's gone off.
I'm coming. I'll take it there. I'm asking, what does this mean? I said you earned revenues of 1,000 cedis, but the cash you received was 1,200. What does it mean?
Meaning there has been an overpayment.
Good. You were supposed to be paid 1,000. However, you received what? 1,200. Good. Now, this is what the concept is talking about. Accounting concept is part of the conceptual framework. Now, the concept is saying that because you work for only 1,000, the cash you should have recognized, even though you received 1,200, the 1,000 is revenue. Please, I'm doing double entry. But the remaining 200, it is never revenue. So we treat it as a liability. Do you know what a liability is?
It's debt.
Debt. It means that, and it is a current liability. It means that this 200, definitely the owner will account for it. Please, are you getting what I'm saying?
Yes.
So it is not your money. You've not worked for it. What you work for is only the 1,000. And the concept is saying that recognize only what you earned and not what you received. Please, are you getting it?
Yes.
Let me use another example. So, you see here we are using dual concepts. That's the double entries. You debit one account, you credit another. This is 1,200. You see that the debit received all the 1,200, but the credit we splitted it to its respective accounts. Revenue account receiving 1,000, then current liability receiving what? 200. Please, you understand?
Yes.
Now, let me give you another scenario. So what if, let's say you were supposed to receive revenue 1,000, but the cash received was, let's say, 700. What does it mean?
Your employer owes you 300
Yes.
cities.
So this 300 is what? Your money. It's your assets. Okay? It's your assets. By your employer, this year becomes a liability, right?
Yes, on your employer.
By year, no, I'm trying to talk for this one. By year, the 300 becomes an asset.
An
So
asset,
therefore,
yes.
the double entry for that 300 becomes, first of all, since you received what? Cash of 700. But you weren't supposed to receive only 700. You were supposed to receive 1,000. The standard is saying that recognize revenues when it is earned. When it is earned, this is the end. So what you earned wasn't 700. What you earned was what? 1,000.
1,000.
What you earned was 1,000. This is revenue earned. This is the end. So since you received 700, you would have to add the assets of 300 to it so that you get the end. Then you credit revenue of what? The 1,000. So this becomes a double entry. 700 will go to cash. 300 will be an asset, and it is a current asset. Then the 1,000, the full amount, will be what? Revenue. Please, you understand?
Yes.
Okay. Now, the same happens to expenses. I said recognize expenses when they are incurred. I told you that expense is a cost that has been what? Consumed. So when you buy a bottle of water, let's say 3 cedis, let's assume this is a bottle of water. I use this to explain what an expense is. And I said that so far as you've not opened the bottle of water, you can give it back or sell it to another fellow for your 3 Ghana cedis. I've written 30 cedis. For your 3 cedis. But the very moment you open it or even unseal it, you see that the bottle water loses value. And that loss in value is what we call an expense. Okay, so expense is what? A cost that has been consumed. Please, you understand?
Yes.
That's an expense. Now, let's say your expense incurred. It could be electricity. Let's say it was 2,000 Ghana cedis. However, you paid, cash paid is, let's say, 1,200. Please, what does it mean? There is a difference of 800. You were supposed to pay 2,000, but you paid 1,200 for an expense, electricity. What does the difference mean?
Please come again.
Daddy.
I'm saying that you were supposed to pay electricity expense of 2K. That's 2,000 Ghana cedis. But you paid 1,200. And you will know that there will be a difference of 800. What does the difference mean?
But
Hello?
yes, I'm here.
What does this difference of 800 means?
Cash paid. There's been an underpayment.
Underpayment. So this underpayment, what does it mean? It means you have to top up, isn't it?
Yes. You have to top up
Yes.
together.
So it becomes a liability on you,
Yes.
isn't it? And it's
Yes.
a current liability.
Yes.
So it means that the double entry is that you debit your expense in your P&L, which is 2,000. You credit the cash because I told you when cash is going out, you credit, isn't it?
Yes.
When an asset is reducing, we credit it. Then you credit your current liability. With the difference of 800. So now the debit is 2K. The credit to in total will be what? 2K. Please,
Yes.
what I'm doing, we will see it. It's not that it's not relevant. It's very relevant. Because of that, I wouldn't even clean it. Let me open another this thing. Because it's very relevant. Now, let's start with the income statements. Let me give you formats first. Income statements for the year ended. Let's say 31st December 2x1. We don't know. Now, mostly I use 3 currency signs. I'll use this side to explain, then this side will be my formats. Okay. Now,
Okay.
in quantity, you know that when maybe you buy a calculator, 100 cedis, will you sell it for 100 cedis?
No.
What will you do?
You add a profit on it.
You add a profit, let's say 20 cedis,
Yes.
to get your selling price, right?
Yes.
So the selling price becomes what? Your cost price plus profit, isn't it?
Yes.
That's 100 plus 20, which is what? 120, isn't it?
Yes.
So now, if you want to get profit, because the matching concept, that's what we did not long ago, says that, it says what? When we are calculating our profits, in estimation of profits, this is it, matching. We should match all our expenses against our revenues to get our profits. Isn't it? So that's what we are doing. That's what we've been doing always in quanti and everywhere. Normal mathematics. That's what we've been always doing. So now, since the cost price is coming here, we get profit to be what? The selling price minus the cost price. This is for one quantity. If it is multiple quantities, then profit becomes what? Your sales minus your cost of sales. Please, you understand? This is for 1 unit per unit. Selling price is for 1 unit. That's why I said when you are buying when you buy a calculator, 100 cedis, and you are selling that one calculator, how much will you sell it? You said you add a profit of 20 cedis for one.
Yes.
You get it? So this is for 1 unit, but for multiple units, you multiply by quantity. I believe you've done that in quantity. So profit becomes the sales. That's the selling price times quantity. In quantity, we call it total revenue. And total revenue is what we are coming to use even here. Then the costs of sales. That's the total costs. Here we call it cost of sales. Okay, that one too will be the price per unit times quantity. But this is not management accounting. We are doing financial accounting. So we are focusing on the accounting concepts and maybe the conceptual frameworks of accounting. Okay, there are gaps. You see, I told you that accounting is kinda regulated. It is regulated by the IFRAC board, the IASB, and also the gaps. Okay, it follows standards and it follows compliance. There is compliance in accounting. But in management accounting, there is no compliance. So what we are doing is more of regulated. Now, they are saying that, I believe you understand this one.
Yes.
Good. Now, they are saying that the sales you make, the sales are your revenues. Sales is the amount of money you receive from your ordinary course of business. So if your business is, let's say, selling of tomato, then your sales becomes the amount of money you receive when you sell the number of tomatoes you sell. That's your sale. Now, you see, those goods you are selling, there would be a case that you will sell to a customer and the customer will return them back to you that, oh, these goods are damaged, these goods are not in proper condition, these goods are this, these goods are that. So when that happens, it means that you would have to give them back their money because they bought from you and the goods are not in the right condition. So you would have to what? Give them their money back. Please, isn't it?
Yes.
So when that happens, you would have to adjust your sales. And that sales now would be the sales minus their money that you gave it back. Because the sales here represents the total money you've received. So if you are giving them back their money, it means your sales figure will reduce. So it is the sales minus the returns inwards. Now, returns inwards is also known as sales returns. It means that they've returned the goods back to you. Please, you understand?
Yes.
So since they return the goods back to you, it is prudent that you give them back their monies. So that's why the net sales becomes the sales minus what? The returns inwards. So therefore, in the format, when you take your sales figure or revenue figure, let's say it is 3 stars, 3x, you less sales returns. If there is any, you less it, and what you get, this one you get here becomes your what? Net sales. So that's what I've done over there in the formats. Please, you understand?
Yeah, you continue. I'll get it. I'm not getting that part.
Hello, are you busy?
No, I'm not busy. I'm here. I said, I'm here. I'm not busy. I'm here. Look, I'm here.
Oh, okay. So I'm saying that. The sales figure, sales is the amount of money you've received from your ordinary course of business. Okay. Now, you are dealing business with people. So you have a case that someone will come to you that, oh, we now come it's not in proper condition. I say, and I say, so it is therefore the case that you will give them back their money because when you're on top, right?
Yes.
So you you give the person back his or her money. Now, in so doing, you would have to reduce it from your sales figure. Okay? You would have to take that money from your sales figure. Please, are you getting what I'm saying?
Yes. Yes.
Now, you taking that money from the sales figure is getting the net sales. Now, the net sales is the sales net of any returns you made during the year, the returns that came into the business. So if you sell goods to somebody and they return it back to you, we call it returns inwards or sales return. They've returned the sales you make. So it means that you have given them their money back. Please, are you getting what I'm saying?
Yes.
So when it happens like that, you have to subtract the returns from the sales. So that's why here I did sales minus the returns. Please, are you getting me?
Yes. Yes.
Now, in the format, the three signs, this is me, my style of presentation. Now, even though accounting, there is compliance. Compliance doesn't mean that the presentation should be the same. Compliance means that we have, like, we comply to certain rules. And these rules are in the conceptual framework. That's what we comply to. That's the compliance I'm talking about. The compliance is not about the presentation. So this is how I do my presentation. When I'm presenting, I use 3 zeros. The first one, I use it to make adjustments, like workings. Hello?
I'm here.
You get some that they use only 2 currency signs, but me, I use 3 currency signs because the first one, I use it to do adjustments. But the other 2, the middle one and the last one, is very important. That's what I use to show my this thing. But the first one, I just use it to do some petty adjustments. That's why my currency signs are 3. Now, when you use 3 currency signs, it enables you to make your presentation look nice. Okay. So me, I learned someone's style of presenting. Okay, I learned it. So this things is not that by force and as a first currency sign as a second one and as a third one. You should know how to do your presentation. Please, do you understand?
Yes.
Okay. Now, I'm going to the cost of sales. I'm going to the cost of sales because we are done with sales. Because I said to get your profits, it is your sales minus the cost of sales. That will give you profits. Now, with the cost of sales too, mostly, let's say if you are coming to maybe sell what you have. First of all, let's say you check whether you already have some of these goods available, isn't it? So maybe if it is tomato that you are selling, you would first of all ask yourself, do you have some available for sale? So the ones you have available is called opening stock. Okay. Now, if you have some available, there might be a case that it wouldn't be enough. Do you get it? To sell. So you would have to buy some to top up. Okay. So the ones you buy in addition to the ones that were available is called purchases. Okay, so that purchases we added to the opening stock. Please, are you getting the analogy? Hello.
Hello, Paul. Yes, please. I'm getting it.
Yes, I'm not writing because I want you to get the idea first before I start writing.
Okay.
Okay. So that's how we do it. So when you get your opening stock, you add the purchases. Now, when you were buying the product from the wherever you bought it, maybe it could be from the market or anywhere to your warehouse, you know that there will be some form of delivery, some form of transportation to carry the goods from that place to your place of residence or your warehouse. So that kind of goods or that cost of carrying the goods into your warehouse is called carriage inwards. So that cost should also be included in the cost of purchase.
Okay.
Please, I believe you're getting it.
Yes.
Now, if you bring the goods and you find out that some of these goods that you bought, they are not in the right state. Maybe they are damaged, they are spoiled, anything has happened to it. Those goods that you bought should be returned back to the person you bought from to take your money. Please, you understand?
Yes.
So that one too will be subtracted. We call it returns outward. So it will be subtracted from the cost. Hey. Hello?
Hello.
You can't see my screen.
No.
Okay, I'm fine. Hello?
Yes.
Oh, I don't know how the screen went off. The network. I think it has come. Let me share it with me. Now, what I'm saying is that, let's say you had goods already. Let's say you bought 10 cedis, but it wasn't enough. So you had to buy more in addition, let's say 90 cedis, so that you get 100 cedis of goods available. Now, you realize that when you are buying these goods, there will be cost of transportation on it. And that cost of transportation, let's say, is also 10 cedis, being the carriage inwards. So you would have to add the transportation cost, because we are calculating the cost that you incurred in buying the goods, or the cost that you incurred in the goods you sold. Please, you understand? So that carriage inward should be added to the cost. Now, when you realize that some of the goods are bad. Okay, the 90,000, the 90, let's say it's in millions. So the 90 million goods you bought, you realize that some of them are bad. So you returned some portion, let's say 2 million. When that's 2 million you returned, since you are going to give it to them back, you demand for your money. Like the way the sales people to do. When they get to know that, I do not come out and say, honestly, the same. So if you tell them that, no, sir, give me my money back. Take these goods and give me my money back because I realize that these goods are fault. So when such occurs, when something like that occurs, it means that a laptop is going off, right? It means that you are going to deduct the returns outward from it so that you get 108 million. Now, this becomes the cost of goods available. Now, aside the returns outwards, there are other things you can also subtract. Let me bring it now before. Okay. So this is 2. Now, another thing that you can subtract is goods withdrawn. Let's assume you are the owner of the business. Now you go to your business, then you take some of the goods for your personal use. Or maybe a friend came to visit you. You took some of the goods and you dashed it to the friend. Let's say worth 3 million. Then you dash it to that friend. Oh, fat, and yes, fat. That 3 million of goods that you dash to the friend should be subtracted from the cost. Because what they are here for the Christmas, so we have to take it out from the cost. So you'll be left with 105 million. And now this becomes the cost of goods available after deducting your returns outwards and your goods withdrawn. This one is cost of goods available for sale. But you returned 2 million and also you reduced 3 million for your personal use. I don't know what you used it for. But this becomes what is available for sale. Now, you see, we prepare the financial statement at the end of the year. So at the end of the year, we do stock counting. So when we count the stocks and we get to know that, our closing stock is, let's say, 25 million.
Yeah.
It means that we were able to sell the rest of these goods that were available. Okay. We were able to sell the 105 million that was available to only 25 million. So we have to subtract the 25 million from the cost of goods that were available to know what we actually sold. That's 80 million. Please, you understand? Then we compare the 80 million to the sales we made. So this is what we call cost of sales. So to get the cost of sales, all these things will be done. All this. So the format for cost of sales is that. Who is calling me? Please hold on, someone is calling me. Hello. Hello. Hey, Edumana. Oh, God. Hello.
Hi, I am here.
Yeah, the laptop just went off. I didn't know I'm not charging itself. How? You in righteousness and up to you. He lifts our voice.
We are recording. No.
Hey, sorry. Let me rejoin it.
Good. Say good. I'm going to get that in wall. I mean, I go.
And you remember, the code. I'm not the coach of the competitor.
I was telling you said I should leave, so me tired.
Yesterday, I know a chum of the competitor.
Where's the baby? I'm not a child of your child. Me, you're how many times have I been away? Are we still on? I'll do spaghetti for you with stew. Or you eat rice with stew.
Ooh. Sorry. I was just talking. So I'm saying that now we less the cost of sales. So the cost of sales is that we start with our opening stock, we put it there like this, then we add the purchases. Now the reason why you can see the opening stock is on the second currency side, but my purchases figure is on the first, because I told you this is for workings. I'm using this to make adjustments. So the purchases, I told you that there is carriage on these purchases. The cost of transportation, TNT, the cost of transporting the goods to the warehouse, that cost is an additional cost on the purchases. So I have to add it to the purchases. That's why I've made adjustments for purchases. Okay, so that carriage inwards, you add it to the purchases. Then, if some of the goods were sports, like the returns that I was talking about, told you that some of the goods can be sports, I say, so those goods you return them. So maybe those returns goods you subtract, and also there could be goods that you withdrew for your personal use. Hey, which one is this?
This is the earlier one or something.
So there could be goods withdrew. So maybe if you withdraw some goods, you would have to subtract that one too, so that you bring everything here. This becomes the net purchases. So you add that to the opening stock to get your cost of goods available. Now, I told you that it means that this is its cost of goods available. It means that you had, at the beginning of the year, you had, after deducting your returns and your goods that you withdrew, you had 105,000 or 105 million goods. Now, at the end, after doing stock counting, we realized
please,
that.
hello, Paul. Please, I can't see the other one, the one you are writing now. Oh, you are not writing. I can't see the sheet you are
I'm not
writing.
writing. I'm not writing.
Oh, okay.
Can you see this?
Yes, I can see. Yes, I can see the tick. Yes. Yes, I can see.
It means my presentation is very slow. Oh, this network too.
You've highlighted the writings.
No one highlights you. I don't know why, but.
Okay, since you've not written anything, can we continue?
Yeah. I'm trying to continue. Now, I'm saying that I'm cleaning this. I'm saying that this is the cost of goods that is available. Now, we want to know the goods that we sold. Okay? We want to know the cost of the goods that we sold. So, to get that, we have to do a stock count. Okay? To know the cost, the goods that is currently available. Because maybe at the beginning of the year, we realize that, oh, we have this wealth of goods. So, at the end of the year, we have to check how many do we have. That's the closing stock. So when we subtract what we have now from what we already had. What we get is what we've sold. That's the cost of sales. So to get the cost of sales, we have to less the closing stock.
Mm-hmm.
We have to subtract the closing stock, and when we subtract it, that will give us what we call the cost of sales. So that's cost of sales. You see, we are supposed to less it from the revenues. So revenues, you less cost of sales. So that cost of sales that we are going to subtract, we bring it here. The cost of sales we get, after subtracting this from this, we push it here so that we can subtract it from the sales. Then what we get becomes what we call our gross profits. So this becomes our gross profits. Hey. So that becomes our gross profits. Hello.
Yes.
Now, please, you understand up to this point.
Yes. Yes.
Okay. I'm trying to. We are going to do more additional working. So let me clean this side, so that we can do more of the working there. Oh. Please, what is income? Hello.
Hello. Hello. Hello.
I said, what is income?
Income is revenue got. Oh. Hmm?
Isn't it? I taught you that income is revenues plus gains. That's an increase in an asset or a reduction
Yes.
in liability, which is not as a result of an increase in owner's contribution.
Hmm?
That's income. So I told you that now we are done with revenues. So we have to add the other incomes. And these other incomes are all gains. So we say add other incomes. So the other incomes can be commission received, It could be discounts received. That's the other receivables that are not part of your ordinary cost of business. Maybe if you receive interest on investment or investment income, all these things could be income. So you add them. Now, another form of income could be a decrease in provision. When you make a provision and it's a decrease, when there is a reduction in your provision, that decrease in provision could lead to an income. So you add all this to your gross profit to get your total income. Easy understand?
Okay.
To get your total income. And they are all, this is on the second currency side. This is on the last one. Now, when you get your total income, you less your expenses. Now, the expenses ranges. So the first one I'll talk about is depreciation. The second one too is an increase in provision. I'll talk about all of them. Bad debts, insurance, maybe lights and heating. See, in the States, they have these expenses. Discounts allowed. When you buy stationery too can be an expense, and etc. So you add all of them. Now, please, there could be adjustments on each and every one of them. When you add all of them, you bring them here, then you subtract it. This becomes your total expenses. So when you subtract it from your total income, what you get becomes your net profits. Please, are we good?
Yes.
Now, we are going to take, starting from this place, there could be adjustments on each and every one of them. For instance, investments. Now, investment is when maybe you put your money, maybe you use your money to buy government treasury bills. That's a form of investment.
Yeah.
Now, let's say you buy T-bills, and maybe at the end of the period, the T-bill, let's say you bought a T-bill of 10,000, or you put your money into maybe shares in another company, and at the end of every period, they pay you 200 cedis as dividends. Okay, that dividend is an other income. That's a gain. So that gain, you don't add it to your sales. You don't add it to your revenues here. You don't bring it here. You rather treat it as other income or gains. So that investment income will come here. Please, you understand?
Okay.
Now, provisions. I told you that provisions is as a result of anticipation, the prudence concepts. Now, provision for bad debts. Let's say your provision for bad debts was 5%. Let's say your debtors figure is, let's say, 20,000. This, what is 5% of 20,000?
5.
That's 1,000,
1,000.
isn't it?
Yes. Jason. 1,000. Jason, go into the car and bring my calculator. 1,000. Oh.
It's 1,000. Now, it means that you've made provision. You've anticipated that you will lose 1,000 out of every 20,000 debts people owe you. It means that you accept that when there is a loss of 1,000, maybe people come for 20,000 from you, but they pay 19,000. They don't pay the 1,000 in addition. It means that loss, you accept it. You've already provided for it. Okay? You've already included that that loss can occur because of the prudence concept. Prudence concept says anticipate for expenses. This is an expense. So you've anticipated for it. Anticipate for losses. So you've anticipated for it. Now, here lies the case that when the provision of 1,000, you realize that you let's say you anticipated 1,000, so you got 19,000. Now, if you recover all the 20,000, it means that the provision didn't occur, right? Now, let's say that you recovered 19,500. Which means that you were able to recover 500 of the 1,000. So therefore, the next provision, since you recovered the test figure of 19,500, you said, okay, then let's pay this money is waiting for me. Hello, Mr. Ram. Yes, it means that when we change our decision to decrease the provision from 1,000 to maybe 500 for the next period, so it means that originally the provision was 1,000, but because we've reduced the provision figure to 500, now the reduction in provision. Because here we were supposed to remove 5% of the 9,500, but now we are removing a lesser figure. So that lesser figure that we are removing, the difference between the the original figure and the reduced figure becomes an asset, or it becomes revenue. Let me put it as revenue. Please, you understand?
Yeah.
You understand? Me, yes, I don't think you understand.
Up to the.
Yeah, I don't think you understand. But if you say you understand, fine.
I understand. I understand. The decrease. This thing.
You don't worry. You understand later. Let me not waste time on this because I think we'll be closing very soon. And the next people have called. Next batch. Hey. But we will continue tomorrow.
Okay.
Tomorrow we'll do online. tomorrow we should do online. Okay.
The percentage sign, excuse me, the percentage sign, you were saying it was shift and what?
Percent on calculator.
Yes.
So look for where the percentage, I think it should be the bracket open or close.
I've seen it. Okay.
So it's just
Okay, I've seen it. I've seen it. See, shift plus bracket open the first one.
Yes.
Please, we can continue.
Now,
We
are done with the income statement. There is another statement called the statement of financial position. I know I've done the format with you.
Say again.
There is one statement called the statement of financial position. And I said, I know I've done the format with you, but I'm just recapping it. We have the cost, we have the accumulated depreciation, we have the net book value. Okay. And I told you that it starts with your non-current assets. So you list them. The non-current assets may be building. You bring it here, you less the depreciation, then you bring the amounts. Maybe maybe furniture and fittings. You bring the cost here, you less the depreciation, then you get the amounts. What again? Motor vehicle. Maybe you bring the cost here, you less the depreciation, you get the amount. Now, when you are done, you total everything. So the total will come here, this one too will come here, then you get the difference. Now, when you are done, you add your current assets. I told you that the accounting equation is asset is equal to capital plus liability, and the asset is your non-current assets plus your current asset, being equal to your capital. Plus your non-current liability plus current liability. And I told you that capital has a structure. The opening capital plus your profit minus your drawings. This is a capital structure. So this is what we are using to prepare the statement of financial position. So we are done with this side. Okay, we are done with that side. So I'm moving to here. That's why I said current assets. So current assets, I spoke of inventory.
Inventory, receivables.
Yes. Inventory. Now, receivable. So, under the receivables, you see, we were doing adjustments.
Yes, whether less or earnings and other things that come up.
No. Yeah. Under receivables, we were doing adjustments. It's not yet. I'm not
Is
sure.
it that the under receivables, the ones that you budget that the person might not return it, and the ones that
yes.
that you
so those adjustments will be subtracted. So I bring the receivables figure here. So provisions for receivables or bad debts, we subtract it. Then maybe the bad debt itself, if it is not already subtracted, you subtract. But if it has been subtracted, you don't. So the provision will come. Then you get your net receivable. Then other things could be those assets that I was talking about. You see, we were doing something like, I told you that, when you receive maybe revenue, you were supposed to receive 1,000, but you received only 700.
Yes.
The 300 becomes an asset.
Yeah.
That asset is called maybe revenue owing. Now that owing is an asset to you. So that revenue that is owing to you should come here. That revenue owing. We call it income owing, not revenue owing, because revenue, we treat it at the top. So income owing, but you can still call it revenue owing, okay?
Okay.
You see, the first one, I didn't expand it this way. That's why I'm doing it here for you. Now, if there is cash or bank, that's your money in the bank or on you add all these, then you get your total assets. When you add the current assets to your non-current assets, you get AAA as what? Your total assets. Did you understand? So that's it here. Total assets. When you add it, when you're done, you come to your financing aspects. I told you the first side is the investment assets. The investment aspects, and we invest in assets. So when you are done investing, first of all, you seek for funds before you invest. So you go to the financing. Financed by, what do we use in financing? Capital. So this capital is the opening capital. You bring the figure, then you add profit, and this profit is the net. You see the profit we got here?
Yes.
The profit we got here, this net profit, we will bring it here.
Then
let's
draw
it. So we less the drawings, and that will give us the net of the capital. Then we add the non-current liabilities.
So maybe the bank loans or something.
Yes. So the bank loans and those things, debentures. So loans, debentures, all those things. Even it could be a deferred tax liability. We add all of them. Now, when we add them, then we can add our current liabilities. These current liabilities can be our payables
And accruals.
Now, do you know the accruals I'm talking about?
Other things that came in place, so maybe the lights or electricity, something, or maybe.
Yes, they're always. You see here, I said it becomes a current liability. That current liability is an accrual. Listen, you were supposed to be paid 1K, but they paid you 1,200. The 200 that is there is an owing. Owings are called accruals. You are owing it, so you have to pay it back. You earned salary of 1,000, but they paid you 1,200. The 200 you've not earned it, so you have to pay it back. So that owing is an accrual. So that's what I mean by current liability. It's an accrual. You see, I said it's current liability. So that current liability is an accrual. If there are bank ODs, bank overdrafts, you bring it. Then I'm a church one. I'm not writing well. So we say current liabilities, we have payables, we have accruals. If there are bank overdrafts, we bring it. Any form of debt, we bring them all. Then when we bring them here to the last currency sign, then we see we add all the three. This is the capital, this is the non-current liabilities and current liabilities. When we add all the three, we should get the same thing as the total assets. So the same thing in the sense that if the total asset was A, then we should also get A.
Yeah, okay.
So that we can say that we've balanced the sheets. Please, you understand?
Yes, please.
Balance the sheets. So in our next meeting, we'll take a typical question and we solve it.
Okay.
Are you good?
Yes, I am.
Okay. So let me take screenshots of what we did today and send them to you. Mr. Ramadan, please, I'm on my way coming.